Hi there. Many landlords pay more capital gains tax than necessary. Here's what you should know before selling.
This chart tracks the decline of the UK capital gains tax allowance. Until recently, property investors had a comfortable cushion. A £12,300 profit was completely tax-free. Today, that threshold has dropped to just £3,000. For a landlord selling a property today, this shift represents an automatic £2,200 tax hike. It is a cost built into the legislation, regardless of how well the property performed. I'm with my tax accountant. We specialize in helping investors navigate these legislative shifts. Our goal today is to look past the top-line rates and show you how to legally shield your buy-to-let profits from HMRC. Accepting a baseline tax bill is a choice. Proactive strategy is the only way to defend your margins against changing tax laws. Consider the case of David. He's a high-rate 40% taxpayer who bought a rental property for £150,000. He's selling it now for £250,000, resulting in a six-figure capital gain. We start by applying the £3,000 annual allowance. In this visualization, you can see how little that deduction impacts the total gain, leaving David with £97,000 of taxable profit. Since David is in the higher income bracket, he's subject to the 24% residential tax rate. Apply that to his remaining gain, and his tax bill lands at £23,280. That £23,000 is our starting point. From here, we are going to use specific legal frameworks to systematically bring that number down. The first layer of defense is identifying allowable deductions. It's important to distinguish between maintenance, like a boiler repair, and capital improvements. Only capital improvements, which add lasting value to the property, can be used to offset your gain. During his ownership, David spent £10,000 on a loft conversion and incurred £2,000 in legal and buying fees. Deducting these costs reduces his taxable gain by £12,000 immediately. Next, we look at David's history with the property to see if he qualifies for private residence relief. If you ever lived in your rental property as your primary home, a portion of the gain is exempt. HMRC includes the final 9 months of ownership in this relief. David owned the house for 10 years, living in it for 2 before renting it out. Adding these periods together carves out 27.5% of his remaining gain as tax-free. Utilizing this historical data removes over a quarter of the taxable gain from the final calculation, without David having to spend any additional capital. Another strategy involves Section 58 of the tax code. This allows for asset transfers between spouses on a no-gain, no-loss basis, meaning no tax is triggered by the transfer itself. Before selling, David transfers 50% of the property's beneficial interest to his wife, Sarah, using a declaration of trust. Bringing Sarah onto the deed lets the household use her £3,000 annual allowance, doubling their tax-free exemption. As a basic rate taxpayer, her half of the gain is calculated at the 18% rate, rather than David's 24%. Balancing asset ownership across household tax bands is a highly effective way to neutralize the impact of the higher rate bracket. Finally, we look at David's income tax bands. Making a personal pension contribution actually stretches the basic rate band upward. By expanding that lower band, you can shield a portion of your capital gain from the 24% rate, keeping it within the lower 18% tier instead. A gross pension contribution of £7,000 stretches David's threshold, allowing an additional £7,000 to be taxed at the lower rate. Combined with Sarah's strategy, the final bill is significantly lower than the original $23,000 we started with. CGT mitigation is an additive process. No single tactic solves the whole problem, but layering them preserves the profit you've built over the years. Timing is critical. You have a strict 60-day window from the date of completion to report your disposal to HMRC and pay any tax due. If you miss this deadline, you face immediate penalties and interest charges that begin to erode your savings daily. Tax legislation changes frequently. This guide is for educational purposes, and the effectiveness of these strategies depends entirely on your specific circumstances. For a bespoke strategy, contact our experts at My Tax Accountant. We can help you navigate the reporting process and optimize your position. Subscribe to our channel for weekly updates on property tax legislation and accounting strategies for UK investors. Relying on default tax rates is a common mistake. Professional planning ensures you keep as much of your investment as the law allows. Thanks for watching.